Alright guys, it's Austin Booley again. I'm doing a quick video. It should be super quick. Hopefully it is, of how options contracts actually make money if you're day trading them. Okay, sorry I'm not showing my face, but again it's a quick video and I'm in a weird place. Alright, so of course we can do this with any stock or ETF or index fund, but right now I have SPX pulled up, and let's go to trade so we can check out the options here. So just so I can show y'all how this works, y'all can do this with anything, but I'm gonna pull up the first one I see. You can this works with every single contract on TD Ameritrade. You go in, you right click on the contract that you want to look at. So for example, this is the 2,605 strike price, the call. So if we look, I copy this, I go up into my charts and I paste it in. This is what the actual contract traded, okay? So this is the actual price movement of the contract. So as we know, Friday was a very red day in the markets, so that's why this call went down. It went down, looks like about 69%. Okay, but since the markets went down, I guess we want to look more at a call. Let's go back to our SPX. Okay, so we obviously know the puts were up so much. So I was focusing on the 1620 call. This was a call I got at 260. Let's take a look at it. Of course, these contract prices trade in conjunction to the stock price or ETF or index price. So when the stock or ETF moves, these put contracts, like if it moves down, the put contracts increase in price. If the stock or ETF goes up, then the call contracts increase in price. Okay, so remember, it was a very red day. I picked up, so this must not be the one I picked up. Down at 560. Yeah, I traded it much less than that, but whatever. So it was a red day, so if you would have bought some put contracts at the break of the triangle, I know you can't really see it here, but on the SPX chart, there was a perfect setup for a triangle. I know it's going to look nothing like this, but on the SPX chart, it was like, oh, triangle breakout. And so you would have bought here. I mean, 14, that is a lot for stock. Hold on. But I mean, as you can see, if you would have bought the contract here at $14 a contract, it went down, so the put contracts increased to $37 a contract. So the way the contract prices increase is it increases in your direction. If it goes down, the put contracts go up. If it goes up, the call contracts go up. Just for a very quick example, oops, I'm still on the specific call. Let's go to SPX. I'm gonna look at the chart. Nope. Charts. Yeah, if you're wondering why that was only like 4 cents of my net liquidity, it's because it is. I moved my money out of TD to Tastyworks. It's in the process right now. So let's look at this. Obviously, it was a sharp drop, so your put contracts would have increased. So I would have entered at the first rejection of the EMA line and the break below this line. So right there, that is 8:48 Monday. So let's go to this, and I'll show you how it actually works. I hope I'm not going over too much time. I want it to be a short one. Monday, 8:48. I would go faster if this would go faster. 8. That works. Go. Sorry, it's gonna take a while to load because TD Ameritrade is slow on this, but I just want to show y'all how this works. So obviously we get that rejection of the EMA. It breaks below our line. We go in. We're like, okay, some puts would be good right now. Let's go back. So I would have traded the 0 day because it would have been the most volatile ones and the most inexpensive ones. So I prefer when the contracts are about $100 a contract, and I buy like, let's go this one. This one looks good. It's because we're buying a put because we want it to go down. We buy at 160 about, place it at the mid. I would personally on this, I'd pick up 3 contracts. Send. Okay, now we have the three put contracts at 148 a contract. So $148 times 3, that is how much it costs to enter this trade. Now if we go to the charts, obviously it's going down in our favor. So let's pull up this trade tab. Obviously we're up $21 just so it makes more sense. You can see it out here. Let's see if I can. Yeah, I can. Okay, so now we can see P&L and resemblance to the chart. So now as we watch the chart drop further, of course we're up more money. Alright, so we're watching it drop. We're currently up $21, but again, you would be up more, but I mean, so you had $148 a contract times 3, so you paid $444 plus commissions to get into this trade, and right now it's sitting at $155 a contract. So your trade price is what you bought it at, the market what it currently is. It's going down, it's going in our favor, so our puts are increasing in value. The same thing works for the call, but the opposite direction. Let's just speed this up because we all know how this ends. 13, I don't need that 0. Alright. Now we're way down here. Now let's wait for this to increase in price real quick. So obviously it dropped so far, and since when the stock goes down, the puts increase in price. So the puts went from $148 a contract to $3,200 a contract. So with 3 contracts, I entered for $444, and we are now at $3,275 a contract, which gives me a P&L of $9,000 for the day with only 3 contracts. The reason why our P&L is that big is because of this crazy move. Again, crazy moves like that don't happen, but you still see that huge percentage gains. We would close out for the day, of course. Sell in the middle here. Firm, send. Just let my contracts know. So $8,826 on the day. That is just how the puts increase. Of course, the calls increase in the same way. I'm going to have to update that, but I hope that helped. I hope this was a quick video, and I didn't mean for it to take too long. If you want to join a chat, it would be Options Traders, which is down in the link below. All right, bye, and hope that helps.